Let's kick off with the Monetary Policy Committee, and your predecessor, Tito Mboweni, was certainly reticent to publish the minutes post the MPC meeting. Is this something that you're going to take into consideration and maybe consider doing just for the sake of further clarity for the market?
No, I don't think so. You know, I think there are a number of issues around publishing minutes. First of all, the core purpose for me is that you have full, frank discussions that are uninhibited. And when you have minutes that are published, then people will talk to what may be published about what they said or the positions they took. And I don't think you have the same quality of discussion. The second question for me is that we come straight out of a meeting, we put a statement together and we answer questions, so that you get, in fact, an immediate response in the detail to any questions that are asked at that point in time. So I think you actually get a better communication than a post-meeting sanitized set of minutes. I think we're more transparent.
Looking at the 25th of March and the interest rate decision that caught 22 economists were polled in South Africa by Reuters, 19 of them got it wrong.
No, I think it depends what they were looking at, because on the other hand, there were many analysts who looked at it and said, in fact, they may have a house view of neutral, but they were actually expecting something. We had given an indication at the previous meeting that this was not a cut and dried issue. So I think it's important that people, you know, that we be as transparent as possible, that we do give signals at the meeting, as little as possible in between meetings, because this is a committee system. This isn't a governor that's able to just say, this is what I'm going to do or not, and therefore to read that in. So I think I don't think they should have been that surprised, and I think there were a lot of other market elements that were not surprised.
If we come to the interest rate decision and where we stand now, there are a number of economists now straight-lining it and saying, oh, it was all about Rand strength. So if we see the Rand strengthen on a trade-weighted basis from the 25th of March to the next MPC meeting significantly, then we need to factor in another interest rate cut. Is that an ignorant approach in your opinion?
I think it's oversimplistic. I don't think there's any question about ignorance, because I don't think our economists and analysts are ignorant at all. I think it depends the way they see and how they read what you're saying. And I think we've been very clear to say that the factors we took into account were a combination of factors. Rand strength, including Rand strength, that gave you the opportunity to look at, we had more certainty on what the Eskom implications were. You had the better numbers around and expectations around inflation for the forecast future. So we felt that although there was a beginning of the upturn and coming out of the recession, we were still very concerned about consumer strength, and that this was a very tenuous recovery. And we felt there was room to take a decision of that nature and reduce the rates. The consequent numbers that have created all this discussion about now must we assume there's another rate cut because of these numbers is taking 1 month's bad numbers out of context and not recognizing that it was precisely what we saw in the tenuous nature of the recovery that enabled us to take the decision. It doesn't mean that we're going to necessarily do that again. We will weigh up the data.
Looking at that data, there's one anomaly out there in terms of vehicle sales. I know it's off a low base, but we are seeing traction on that front. And yet, if you look at private sector credit extension growth, it's absolutely at zero. And we know that South Africans don't buy cars in this country for cash. So can you marry those two data points for me?
I think there is a question of what is driving the vehicle sales, and you'll see a lot of it relates more to export and to other factors, not necessarily the domestic demand. So I do think the numbers can be a little bit misleading if you simply read them at face value. On the other hand, though, there is definitely movement in the right direction. I think that what's happening with consumers, though, is that those who can afford to do something about their levels of debt are deleveraging. And therefore, there isn't a demand side for credit extension at this point in time. It's still very, very low. So there's a lot of difficulty out there still, and certainly that is our view, that this is much more likely globally to be prolonged and lower recovery, although all the numbers coming out from the IMF and their reforecast are for better numbers, and we hope that that is the case, because obviously that is what we would all like to see.
Taking the consumer into account, that debt to disposable income that you're referring to is still very high. Do you think
79.7%
it has plateaued at this stage?
I'm not sure. I think we have to see, and I hope that it doesn't increase. I think that the experience over the last few years will certainly be important for consumers to look at the approach to debt, and let's hope that the numbers come down. And therefore, as things grow, that household debt leverage, household debt ratio does come down. But again, you know, the concerns that one has around these numbers is the level of unemployment, what is happening to growth. All of these things will impact on what consumers can do.
Turning to the international arena, the statement has been made that this is the decade of sovereign defaults. So do you keep one eye on the international data flow, just looking at what is unfolding on Greece? The situation certainly hasn't been resolved. They're now looking at 80 billion euros to prevent a default rather than the 45 billion that they currently have access to.
There's no question that the level of debt and the size of deficits is, in my view, a huge global risk, and something that you have to not just keep one eye on, but as many eyes as that you can, and try to understand what lies behind it, because at the moment Greece is battling just to roll over the debt that it needs to roll over, not to address all its problems. I mean, its deficit is 13%. The Maastricht Agreement is 3%. So if you have to reduce your deficit by 10%, look at the impact on that economy in terms of expenditure, in terms of employment, especially because it does not have the opportunity to devalue its currency because they're part of Euroland. So huge challenges. And then bear in mind that that's one country out of the ones that are being looked at the moment that are having difficulties.
And exactly that point is contagion.
Well, it's not necessarily contagion at the moment. They all have similar problems. What could arise is how you deal with Greece and how the issue is resolved will determine the extent to which Ireland, or in fact Spain, Spain's 5 times the size of Greece. Its unemployment levels are already above 20%. So huge challenges for Spain, and their banking sector, their housing market is going through very rough times. So it's very important for the European Union to address the resolution of Greece, understanding the bigger picture.